Investors seeking dependable income-generating assets face an increasingly complex environment, particularly amid heightened market volatility and shifting macroeconomic dynamics. High-yield telecom stocks, such as Telus, which currently offers a 9% dividend, present an attractive headline yield but are accompanied by underlying risks that could affect long-term income sustainability. In contrast, Brookfield Renewable Partners, TSX BEP.UN, offers a balance of income and growth that may appeal to investors seeking both stability and exposure to emerging technology trends. The company provides a 5.1% dividend yield while maintaining a strategic positioning to benefit from the ongoing AI data center expansion. Brookfield Renewables operations are anchored in clean energy production, which is projected to expand as demand from data centers and cloud computing infrastructure continues to grow. Its disciplined capital recycling strategy allows the firm to fund expansion projects without straining its balance sheet, ensuring dividend continuity while preserving flexibility for future acquisitions or development projects. With an estimated $10 billion investment pipeline over the next 5 years, Brookfield Renewable integrates growth potential with income reliability, offering investors a diversified exposure to a sector that intersects both environmental trends and technological adoption. This combination makes it an attractive alternative for income-focused investors wary of potential volatility in high-yield telecoms, such as Telus. Shifting focus to the AI infrastructure sector, Supermicro Computer Inc.'s NASDAQ SMCI has demonstrated both the opportunities and challenges inherent in rapidly scaling technology firms. On Thursday, Supermicro shares fell 8.6%, closing at $30.85, following a sharp 13.8% rally on Wednesday, driven by its upgraded fiscal 2026 revenue forecast. The two-day price swing underscores the market's sensitivity to both growth expectations and margin pressures, highlighting the high beta nature of AI infrastructure stocks. After-hours trading indicated relative stability at the $30.85 level, though investors remain attentive to upcoming macroeconomic data and company-specific developments. Supermicro's fiscal second quarter results for the period ending December 31st reflect strong top-line momentum. Net sales reached $12.7 billion, exceeding analyst projections, driven by persistent demand for AI servers and data center solutions. However, gross margins declined to 6.3% from 9.3% in the prior quarter, reflecting higher production costs associated with scaling operations to meet the surge in AI hardware orders. Founder and CEO Charles Liang emphasized that the company is scaling rapidly to support substantial deployments for major cloud and AI clients, indicating the trade-offs between growth and profitability in a capital-intensive sector. The company raised its fiscal 2026 revenue forecast to a minimum of $40 billion, up from a prior projection of $36 billion. Delayed shipments totaling approximately $1.5 billion are expected to be fulfilled in subsequent quarters, with third-quarter revenue projected at $12.3 billion. CFO David Weigand underscored that order strength remains strong, reflecting continued demand across AI and cloud computing infrastructure projects. Analysts describe Supermicro as an integrator, providing critical solutions to some of the largest cloud providers and AI operators, thereby placing the firm at the center of a rapidly expanding AI hardware ecosystem. Supermicro also issued cautionary guidance in its SEC 8K filing, noting that larger contracts may concentrate the customer base, potentially increasing revenue predictability risk. Additionally, the firm highlighted exposure to cost fluctuations, tariffs, and pricing pressure that could further compress margins. These disclosures provide investors with a nuanced perspective on the operational and financial risks that accompany high growth in a volatile sector. The broader market context added to investor uncertainty. Thursday's sell-off extended across AI-related stocks, with NVIDIA declining 1.2% and AMD falling 3.9%. The NASDAQ closed at its lowest level since November, partially influenced by Alphabet's announcement of increased AI spending, which fueled concerns about whether large-scale investments will translate into sustainable earnings growth. Tom Hainlin, an investment strategist at U.S. Bank Wealth Management, observed that market participants are carefully weighing whether current AI capital expenditures will deliver tangible financial results, underscoring the heightened sensitivity of tech stocks to both earnings quality and forward guidance. Trading activity in Supermicro was notably elevated, with approximately 56.6 million shares changing hands, more than twice the 50-day average, indicating high market engagement and volatility. The heavy volume reflects investor interest in interpreting short-term earnings developments against longer-term operational scaling, particularly in AI server and data center markets. Brokerage sentiment on SMCI remains mixed but broadly constructive. Raymond James Financial reduced its price target from 50 reais to 35 reais, while maintaining an outperform rating, signaling tempered optimism. Other notable updates include Argus with a $64 target set on November 6th, Zacks Research upgrading the stock from strong sell to hold on December 8th, Mizuho assigning a $33 target, Goldman Sachs reiterating a sell rating with a $26 price target, and Citigroup lowering its target from 48 reais to 39 reais, while assigning a neutral rating on January 20th. Analysts collectively maintain a consensus hold rating, reflecting a balance between strong revenue growth and margin-related risks. The second quarter fiscal 2026 results highlighted both opportunities and challenges. Revenue of approximately $12.7 billion represents a year-over-year increase of roughly 123%, with adjusted earnings per share of $0.69. Management issued guidance for the third quarter at $12.3 billion and full-year fiscal 2026 revenue at $40 billion. Boutique firms, including Rosenblatt Securities, maintained buy or outperform ratings, reflecting continued institutional support and confidence in growth prospects. Elevated options activity, with roughly 390,000 call contracts traded, coupled with heavy stock volume, signaled directional investor interest and a speculative response to the earnings report. Supermicro management emphasized the data center building block solutions (DCBBS) segment as a potential long-term margin driver. This higher-margin business has the capacity to improve overall profitability if successfully scaled. However, adjusted gross margins remain a point of investor concern, having declined to approximately 6.4%, a multi-quarter low. The firm attributed the margin contraction to product mix, expedited production costs, and customer concentration. Goldman Sachs reinforced downside risks with a sell rating and a $27 price target, emphasizing the sensitivity of shares to both margin performance and DCBBS execution. Institutional ownership remains high, underscoring confidence in the company's long-term positioning. Recent activity includes new stakes by Anfield Capital Management LLC, Twin Peaks Wealth Advisors LLC, and Flagship Harbor Advisors LLC, each valued at approximately $25,000. Armstrong Advisory Group Inc. acquired a position worth $29,000, while Concord Wealth Partners increased its holdings by 2,564.1% in the fourth quarter, now holding 1,039 shares valued at $30,000. Overall, approximately 84% of SMCI shares are held by hedge funds and other institutional investors. From a technical and financial standpoint, Supermicro trades with a 50-day moving average of 31.38 and a 200-day moving average of 41.34. The company has a market capitalization of $18.42 billion, a price-to-earnings ratio of 23.02, a PEG ratio of 0.61, and a beta of 1.53. Key balance sheet metrics include a debt-to-equity ratio of 0.72, a quick ratio of 2.95, and a current ratio of 5.39, reflecting adequate liquidity and manageable leverage. Looking ahead, market participants will closely monitor whether SMCI can maintain levels near $30 following a week of pronounced volatility. Broader macroeconomic developments will also influence performance, with the delayed U.S. January jobs report scheduled for February 11th and January CPI data on February 13th. Investors will evaluate whether Supermicro's substantial revenue targets can be realized sustainably amid operational pressures, margin compression, and the evolving dynamics of AI infrastructure demand. In conclusion, Supermicro's recent performance illustrates the interplay between rapid revenue growth, operational scaling, and market sensitivity in the AI hardware sector. While the company benefits from robust demand and strong institutional support, margin pressures and concentrated customer exposure present ongoing risks. For income-focused investors, Brookfield Renewable Partners offers a complementary exposure, combining stable dividends with participation in growth sectors such as AI-enabled clean energy infrastructure.